A strange thing is happening in oil markets. The Organisation of the Petroleum Exporting Countries, better known as OPEC, and its allies are cranking up output just when the world is worrying about an economic slowdown. It's a major change in policy, and it's pushing oil prices down. Now, OPEC, led by Saudi Arabia, is widely viewed as a cartel. And cartels are typically associated with pushing the price of a good or service up. So what's going on? And what are the potential implications? We thought we'd dig in. It's what we do here on Reuters Econ World. Every week, we pick a phrase or buzzword and go deep on the economic principles and ideas driving the biggest news around the world. So this week, OPEC Plus. I'm your host, Carmel Crimmins, in Dublin. To get into OPEC Plus and why its leader, Saudi Arabia, is driving oil prices down, I'm talking to Ron Bousso. He's an energy columnist for Reuters, and before that, he spent years reporting on the world's biggest oil and gas companies. Hey Ron, how's it going?
Hi, Carmel. Oh, good. Thank you. London is, it was warmish and now it's turned cold again, but it's good. It's good, thanks. How you doing?
Listen, we take what we can get, right? So Ron, you've been covering the energy markets for a long time. How would you explain OPEC or OPEC Plus to someone who doesn't spend their life, watching the price of Brent crude?
So OPEC is a group of the world's top oil producers, mostly Middle Eastern and North African producers, that since the 60s has kind of united in this very powerful alliance to jointly manage the oil market. Many people refer to it as a cartel, and there is some merit to that title, given that they control around 40%, up and down over the decades, but a large chunk of market. And since 2016, OPEC created this very important alliance with other producers led by Russia, but not only Russia, Kazakhstan was there too, and others. Together, they've kind of tried to coordinate oil output. And it was quite a success. It has been quite a successful alliance. Particularly, we saw that during COVID,
right,
when global demand collapsed. They managed to really work things out between themselves and help manage the oil market to avoid complete turmoil. And since then, they've kind of limited their output in order to maintain oil prices relatively stable at a price that works for them and arguably works for consumers.
But currently, something different is going on, right?
Yes, this is a very interesting dynamic. And it's essentially kind of a survival of the fittest scenario. So if you imagine oil producers around the world, in Saudi Arabia, in Iraq, Russia, but also the United States, each one of these has a different cost for producing a barrel of oil.
Right.
And this is very important. So what has happened in recent years, and it's kind of periodic throughout kind of OPEC's history, is that non-OPEC producers and non-OPEC plus producers used the relatively stable oil prices to increase their production.
Mm-hmm.
So companies invested in places like the US shale, onshore production, or Brazil or Guyana, and started drilling and produced quite a large volume of oil.
Right.
More recently, within OPEC Plus, things have become a bit unsettled because some members, primarily Kazakhstan and Iraq, but also the UAE, the United Arab Emirates, started producing above their agreed quotas.
Okay.
So if OPEC is a group of producers that agree we are going to produce at this level, and then they divide it among themselves, you have this quota of production, you have that quota of production. So we're starting to see this lack of discipline over the past, over the past couple of years, but it's become more pronounced in recent months.
And why is that happening? Like, why is discipline breaking down?
Various reasons. I think there's no one specific reason, but if we look at the main culprits, Kazakhstan, at the beginning of the year, Chevron, a big American company, started production from a huge expansion project in Kazakhstan, which really increased the country's oil output significantly. And under the agreement of the OPEC Plus deal, Kazakhstan should maintain its production stable and suppress the quota. But that's not really possible, and for various legal reasons, but also the government decided it doesn't want. So there's that. Iraq, similar things. It has capacity and it needs the money, so it decided, okay, we'll increase a bit. So each of one of these countries gradually increases its output, and it sums up to quite a lot of oil.
Got it. So one country on its own might get away with it, but if you've got a number of them, then that begins to get noticed. So what does Saudi Arabia, like the de facto leader of OPEC, do about this lack of discipline?
So what happened was, as disciplined freight and Saudi had struggled to impose the terms of this agreement on other members, it lost patience. And last month, it decided to accelerate the unwinding of some of the production cuts. So in the May OPEC Plus meeting, they decided to again increase and accelerate the unwinding of the cuts by adding an additional 411,000 barrels per day to the market. And again, that's putting a heavy pressure on oil prices. But more broadly, Reuters has reported that the Saudis have really lost patience with the countries that are non-compliant. And the kingdom is signaling to the market that it is willing to enter a period of pain, which we call a price war, in order to correct the market and teach some of the producers a lesson and increase its own market share. That's also part of the calculus for Riyadh. We can withstand low oil prices much more than competitors. And when competitors produce less, we will take over those barrels.
How can Saudi do this? I suppose, why is it the de facto leader of OPEC? Is it the sheer quantity of oil that they produce?
Yes, it's output, but also it's the size of its output, but also the cost of its output. It's probably the lowest in the world. And by low, we're talking very, very low. I mean, it depends how you account for it, but it can be like in the single digit dollars to produce a barrel of oil, where, other places can, have 45, 50 sometimes dollars per barrel.
Oof. Okay, so they've got the fattest margin. Have they done this before? This kind of price war?
Oh, yes, they have on several occasions. 10 years ago, in late 2014, they started another price war. And that was a remarkable one, because what happened was that since the beginning of that decade, US shale production started rising quickly.
Mm-hmm.
And that eroded OPEC's market share in the global market.
Yeah.
US was a very big importer of oil, particularly from the Gulf. And suddenly the country started producing very large volumes of oil and no longer requiring as much imports as it had previously. So what Saudi Arabia said, okay, in this case, what we're going to do is we're going to crash the oil market, flood the market with our oil, push prices down, and that will shut down US shale producers. That was towards the very end of 2014. And throughout 2015, that's indeed what happened. There was a very painful price war for everyone, because prices tanked and US producers, many of them shut down and pulled back production. And Saudi, of course, didn't make as much money, but in the end, did what it intended. It led to lower US production.
Right.
In the long run, though, all it did was it taught American, US producers, but also outside the United States, to operate in a low oil price environment. And very successfully that too.
They became more efficient.
Much more efficient. And rather than needing a price of, $60 or $70 per barrel to economically produce oil, they managed to do it at $40 now.
Oof. Wow.
So yeah, and technology has played a huge role in the shale revolution, and we're seeing it still today. You know, the United States is today the biggest oil producer by a long stretch, and some of its production is quite low cost.
So, like right now, price of oil in and around $60 a barrel. I see Goldman Sachs is forecasting that it'll be below that in 2026, around $56 a barrel. Like, that has consequences.
Absolutely.
Right? Like, you mentioned the shale. So for US producers, is it not such a big deal for them then if they've managed to get their production costs down?
You know, it's a very big deal for them.
Okay.
Because there is quite a lot of data showing that for many US shale drillers, to drill a new well, you would want oil prices of around $60 at least.
Okay.
So there's a distinction between existing wells that can make money at $45 or new wells that you want to drill that require a much higher oil price. And it's a bit technical, but US shale drilling is a manufacturing process. You constantly have to drill new wells in order to maintain your production steady, let alone to increase it. It's quite labor intensive and energy intensive in that respect. So if a driller decides to kind of put down tools and not do anything, it pretty quickly will translate into lower production.
The OPEC Plus production moves are having an impact on oil prices way into the future. It gives us a natural real-world example to look at. Something regular listeners to the show know we do every week. But maybe this week's real-world example would be better off called Geek's Corner, because it's all about the shape of the forward price curve. Ron, can you explain to our listeners about contango and backwardation? And feel free to take a little drink of water before this if you need to kind of prepare yourself.
Deep breath. No, it's actually not that complex, okay? And some geeks will tell me, of course, it's complex because that's the whole point of it. Commodities, not only oil, anything, grains and metals, they trade on kind of a monthly basis. So contracts that are built for delivery of the goods on a monthly basis. So you have what we call future contracts. So you can actually buy a contract for delivery into the 2030s today. And this creates what we call a curve. You have a monthly contract going on and on.
So you can plot it, plot it on a graph.
Exactly.
Yeah.
And this is called the curve. And the curve, of course, it moves all the time because people buy and sell. And in the world of curves, you have two shapes. One is called backwardation.
Yes.
Which is it's a downward movement.
Okay.
Which means essentially that today's prices are higher than the price in the future. The opposite is something called contango, and it's not a dance.
Well, I think it sounds like a fizzy orange drink.
I see that.
Maybe you can tell me where did this name even come from?
I have no idea.
Okay, forget about the name. Tell us about the details.
So a contango structure is the opposite of backwardation, which where near-term prices are lower than future prices. So going back to today's market, we are seeing something extremely unusual in that we have, in the next few months, a very strong backwardation. But starting from October and the third and the last quarter of this year, everything shifts into contango. It's probably a reflection of a lot of uncertainty. That people think that all the slowdown in economic activity probably will take a few months to kick in.
Right.
And once it kicks in, it will depress demand. And on top of that, you add the fact that you have a lot of oil coming into the market because OPEC Plus is unwinding all of these cuts. And you have non-OPEC supplies also rising. So you have a situation where demand is expected to be low and supply is expected to be high.
Yeah.
So you're creating this strong contango actually in the long term.
So low oil prices in the future, popular for consumers. What about oil traders?
Traders make a hell of a lot of money in the contango because all they need to do is just buy storage, store the oil, and sell it in the future for a higher price. It's a very easy trade.
Ron, what about the impact on OPEC Plus's own members from this price war?
It's a good question, because although Saudi is the lowest cost producer, and probably Iraq and the UAE are kind of in the same very low level, as a country, as governments, they require a very high oil price to meet their budgetary requirements. These are countries that are mostly reliant on fossil fuel revenue. And just to put it in proportion, while Saudi might be able to produce, as we said, below $10 or around $10 a barrel, the country as a whole requires an oil price of $90 in order to meet its 2025 budget requirements.
Huh. Wow.
So it's a huge, huge difference there. And it varies, but it's, we have the same thing with other producers that require, anything between 50 and 120 in the most extreme cases. That's dollars per barrel to meet their budgetary requirements. Now, what does that mean? Is that smaller producers in particular, or poorer countries, struggle. They can't live in a low price environment for long. Whereas Saudi, it has a strong economy, and it's has access to global debt markets. So it kind of tells the market that, yeah, we don't like it, but we can withstand it.
Right.
And if you lose money, believe us, we lose much less because our production is much lower.
Yeah.
Our production cost. So we are in a much stronger position than many others.
Then you've got someone like Russia, right? So Russia's oil price in rubles is at a 2-year low at the moment. So it's 40% below budget level. That's a lot of pain for Moscow at a time when it's fighting a very costly war in Ukraine.
Absolutely. And Russia is also a big gas exporter, and it lost its market in Europe, or most of it. So low oil prices are a big headache for the Kremlin, without a doubt. And it will translate into policy at some stage, whether cutting back. We're already seeing Russia telling kind of ministries to cut back on spending and just paring back its budget.
And we've had Trump say, with the price of oil down, Russia would be in a good position to settle, right? That they would actually be more keen to settle the Ukrainian war.
I mean, I see the logic, but I'm not sure that's exactly how the Kremlin thinks when it comes to Ukraine. And we know that Russia kind of prides itself in being able to absorb pain. But there's no question that when oil prices are low, Russia and other producers are under quite a lot of strain financially. And that could lead to, change in policy and on various fronts.
You mentioned previous times when in Saudi Arabia pushed a kind of a price war, say 10 years ago, and it did work out for them in the short run at least. This time, though, they obviously are trying to control the supply. There's a risk factor, isn't there, on the demand side, which perhaps wasn't there before?
Yes, absolutely. As all of your listeners, I'm sure, are aware, the world is in quite a state of flux at the moment.
We've noticed, yeah.
Because of particularly Donald Trump's tariffs and trade war with China. That has created an enormous amount of volatility in the market, and we're already starting to see that translate into on-the-ground economic and industrial activity slowing down all over the world.
Yeah.
And this is a very big background for OPEC's decision. And the reason is that historically, put simply, when oil prices are low, people feel more comfortable to buy more oil. It's kind of, that's basic economies.
Economics 101.
Exactly. Now, this time, it's not at all certain that we would see a strong demand response because of the trade wars, because of the global economic problems and headwinds we're facing. So this is quite a gamble for Saudi. They can kind of dictate where supply picture is, but the demand side is out of their control. And in this case, where we are today, it feels to me like more than ever, we don't fully understand where demand is going, and if anywhere, it's more likely to go down because of the slowing economic activity.
Ron, thank you so much for your time.
You're absolutely welcome, Carmel. It was a pleasure, as always.
A big thank you to Ron for his time and insight. You can catch his columns on Reuters.com and the Reuters app. Sound design, music composition, and engineering on this episode was by Alex Summer. Our podcast team includes Kim Vinnell, Tara Oakes, Josh Summer, Gail Issa, Christopher Walljasper, Jonah Green, David Spencer, and Sharon Reich Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.